Welcome to the Monocle Banking Podcast. Beyond the vaults and virtual wallets we go. It's a series that's brought to you by Monocle Solutions, where we're delving into the dynamic world of banking. It's great to be back with you. I'm your host, Michael Avery, and in the series, in episode 2, we're going to be exploring SVB and the doomsday scenarios. So whether you're a banking professional, a financial enthusiast, or someone who just simply wants to stay informed about the world of finance, you're certainly in the right place. So let's get cracking for the second episode. Once again, great to have in studio with me the author of Why Banks Fail and CEO of Monocle Solutions, David Buckham. David, great to have you back in. And I think the response that we got from that first episode clearly indicates that this podcast is going places. It's fulfilling a need, I think, in a big gap in the market. So fantastic to be chatting to you again on a very important topic that's very current, and that was SVB, Silicon Valley Bank. And when we talk about why banks fail, we've had 3 major US bank failures this year alone. And in your analysis, you emphasize the fundamental drivers behind the failure of SVB. You cite excess liquidity, misguided regulations. Can you just delve a little bit deeper into those factors that contributed to the bank's vulnerability and then how they played out in the broader financial landscape?
Thank you, Michael. First of all, thanks for having me back. It's really an interesting time that we live in. And if I could give some context to your question about what led to the failure of SVB, is to just reflect on the fact that in the build-up to the global financial crisis, there was an overextension of credit and not enough money at the end of the day. What's interesting about SVB is it's precisely the opposite. There's too little credit and too much money. So there was an 8-fold increase, 9-fold increase in M2 money supply in US dollars. During COVID, the Fed's balance sheet went from $4.5 trillion to $9 trillion. So that's the inverse, that's the other side of money supply. So think of that loosely as a listener as being a doubling of the amount of US dollars in circulation from the period April 2020 to April 2022, literally a doubling of the amount of US dollars in circulation. Then at the same time, you had stimulus checks. There were 3 rounds of stimulus checks of $1,200 each to just about every American, literally. You had student loan write-offs, which are still contentious to this day. And you had about $400 billion of business loans that were written off, and all number of other alleviations to save the American economy by the Fed and by government. Government debt in the US went from about $22 trillion to $33 trillion in that 2-year period, which is why, the Republicans have some point to make. Although I'm not picking sides here, but I mean, this is why we almost had the US government come to a grinding halt.
Well,
so
I'm really pleased that we've had this experiment, because before this there were advocates for modern monetary theory, MMT, or the magic money tree. Don't worry, with the years we can just print money, we can inflate our way out of these. And I think where we are today is quite thankfully dispelling some of that magical economic thinking. But back to your point.
Well, yeah, I mean, I would say one could think of it as an opioid. They printed so much money that I think to some extent they devalued money itself. And they also helped create an environment of greed and gambling, which we saw in the crypto world. And we also saw massive distrust, when you simply print your way out of the global financial crisis for 10 years and COVID. So let's think about it like this. Silicon Valley Bank is a cool, West Coast bank. It's like your go-to bank for venture capitalists. So it has larger depositors than usual that exceed the limit of deposit insurance. So technically speaking, they're not protected by a government guarantee. deposit base is very large. More than 80 or 90% of it exceeds the deposit limit for guarantee. And they receive, they go from being a $50 billion bank to being a $200 odd billion bank, 209, I think, $billion bank in the space of a couple of years. And Gregory Becker, who was their CEO in 2018, was one of the people that lobbied for the stress test limit and the capital charge. All of the rules that were in place for banks around the US that had excluded really small banks under 50 billion. They raised it to 250 billion under the Trump administration in 2018. So SVB was now no longer protected by the same rules that protected other banks and that protected the owners of the bank, like the shareholders, nor protected the depositors. It had grown massively over a very short period of time because there was so much money in venture capital and so much money in tech on the West Coast. Before free money ended, finally when Jay Powell got the message that people were depositing so much money with the bank that the bank literally did not know what to do with the money, which is why I say they failed because they got too much money and not enough credit, because that they ideally should have taken that money and made loans. But they were too busy being a cool West Coast venture capital bank, and they invested a lot of that money, an enormous proportion of that money, in U.S. government bonds, treasuries. They were trading at yields that were at all-time lows and prices that therefore were at all-time highs. So it should have been self-evident to anybody that once the Fed has to fight inflation and raise interest rates, then the future coupon payments and capital repayments on those bonds would be discounted by more, and therefore the bond values would drop significantly. But under the mixed measurement approach to accounting, if you classify those bonds as held to maturity, then you don't have to absorb any unrealized losses or gains on your income statement or in the equity on your balance sheet, which is to say that so long as you don't have to sell them, their value is meaningless, which is crazy. But SVB had some withdrawals, and they had to sell some of their bonds. And Gregory Becker announced that they'd made a $1.8 billion loss to increase liquidity to meet the withdrawals.
Yeah, because this is the real world, and sometimes you do have to crystallize losses, and you
Correct.
can't just pretend you're going to hold things to maturity in some kind of idealized. But, back to the Growth, Regulatory Relief and Consumer Protection Act. It was at the time that you mentioned in the book, the Nonpartisan Congressional Budget Office noted with distinct concern that the rollback would increase the likelihood that a large financial firm with assets of between 100 and 250 billion US dollars would fail. And so there were warning signs flashing in the US about this before we saw the failure of SVB.
Yes, there were. And the San Francisco Fed in November of last year, which is to say literally 6 months prior, should have, they knew this. They knew that SVB had overinvested in government bonds. And, Michael, the extent of this problem is huge. Bank of America has $100 billion of unrealized losses on their government bonds, but they don't have to realize them because they're liquid and there's no run on their bank. But as the CFA Institute has pointed out, whether you're holding it to maturity or whether you intend on selling it, it shouldn't make any difference to the value of the financial asset. It's only because of the mixed measurement approach that this is possible. And in the US stress test scenario, so if I could finish off on SVB. So what happened with SVB is the crisis usually occurs, and we've seen this in history, it's fascinating, all the way from John Law. The crisis usually occurs when a senior figure from the bank announces that they are raising capital or that they need people to bring the gold back, or paper money can't be converted to gold. Whenever someone signals that they need to do this to make sure everything will be fine, that's when people panic. And so when Gregory Becker announced that they had incurred a $1.8 billion loss on their bond portfolio and that they were doing a $2 billion equity raise to fill the hole, that was the death knell of the bank. A few days later, he got on a plane and went to his house in Lahaina in Maui, which very tragically, Lahaina was burnt down. So I'm not sure what the outcome for his house was, but at that time it still existed, and he was seen in flip-flops on the beach, and it was like a really bad look, very poor optics.
Yeah.
Given that, the Federal Deposit Insurance Corporation had gone in and said, no, you got to close this bank down. And they then guaranteed all the deposits, even those over the deposit threshold limit. And they nullified the risk for the depositors, thank God. But they created this massive moral hazard. And shortly thereafter, you had First Republic, and any number of banks could have failed after that. What I find mind-blowing, if I could pivot here, what I find mind-blowing is that only a few months later, so that was in March 9th through to 11th, that all occurred. The Federal Reserve, which, remember, does two things. It runs money, the US dollar. It's got a dual mandate, so it must target inflation and target unemployment, which is unusual, because usually you just target inflation as a central bank. And one can debate whether having a dual mandate is appropriate or not for a central bank. But remember, the Federal Reserve is the institution that's independent from government, that alongside the US Treasury, through its 12 branches and its board of governors, runs the US dollar, targets inflation and targets unemployment, but it also regulates banks. So the Federal Reserve is ultimately responsible for the governance of the banking system.
Yeah.
So when you have three major banks, three of the four largest bank failures in US history occurring in March, and they're running then a stress test in June, you would expect their stress test to address the risks that occurred in March. But no, in their stress test, they predict a severe recession in which the Fed then drops interest rates from 5.5% all the way back to zero, therefore nullifying all of the unrealized losses on all the bond portfolios of all the banks in America, and increasing unemployment from 3.6%, 3.7% to 10%, and experiencing a 38% decline on commercial real estate. But the stress test, because of the 2018 rollback, is only performed on 23 of the 4,500 banks in America.
What?
Only 23 banks qualify under the rollback of having assets of more than $250 billion in assets, and therefore only cover 20% of the commercial real estate market.
So there's 80% of the risk out there that hasn't been covered at all by the stress test.
So that, and they've nullified the unrealized losses on the bond portfolios, which is what killed SVB. They then announced that the banking system's fine, and that leads to several of those 23 banks increasing their dividend payout, which is fine. I mean, I'm happy for the shareholders. But this is the same institution that's running the dollar, and the dollar is the world's reserve currency, and the dollar's fluctuations export inflation, including to us in South Africa. So it's incredibly distressing to me. I read about this it blew my mind when I read about it. It was called the doomsday stress scenario. And the FT, in a reasonably uncritical fashion, called it like a severe doomsday scenario. And I would agree, it is pretty severe.
Because where we sit today is certainly not a situation where we're seeing the Fed funds rate going from 5.5 to 0 in the space of a year. Employment is still very strong in the US. The Fed seems determined to keep rates where they are at the moment. And so this scenario seems highly unlikely that we'll go back to a situation where these losses are not realized. So what happens then if we start to see some of these losses crystallized in the US banking sector? What is the doomsday scenario?
Yeah, for me, the if I was a cynical man, which I'm not, I would say that it's almost a deliberately good scenario that they're calling a doomsday scenario. They're calling it a severe scenario. The real scenario is much more likely to be, and I have the benefit of it being October now, which is they ran this scenario in June, so I have the benefit of it.
Right.
And it's an annual test. But what seems very clear is that the U.S. unemployment rate is, and the new jobs data just came out, 366,000 new jobs, something of that order. That was yesterday or the day before. It seems to me that the U.S. unemployment will stay very low. The U.S. is not going to go into recession. It looks like bond yields are going up, and it looks like the Fed will probably have to raise rates more, if anything, certainly not drop them. That means that we live in a world where the mixed measurement approach has a whole lot of banks with unrealized losses on their bond portfolios. So any bank at which there's a lack of trust for any reason, could be reputational, will have to have a blanket guarantee, which will instantly make those banks non-viable free market entities. So I would predict you don't want to be a mid-sized US bank, but also enormous moral hazard in the system. For me, it's blindingly obvious that you can't design your own test.
Yeah.
There should be another part of it. Could be, for example, the Senate Banking Committee. But then we investigated that. There's a large overlap of the personnel from the Senate Banking Committee that also sits in the U.S. Treasury. So there is a lot of work to be done, I would say, with the governance structure in the U.S. system, which would need to be done.
I mean, it's fascinating because regulatory authorities, financial commentators are often criticized for attributing financial failures to individual actors rather than addressing these underlying systemic issues. And now you're really touching on the root cause here, which seems to be a governance framework that is poorly incentivized to really act within the best interests of the financial system and not potentially, and I'm not suggesting here that there was anything untoward benefiting particular shareholders, but it's clearly a governance system that isn't calibrated to pick up these broad-based systemic risks in the system. So what are the other structural reforms or policy changes that you believe are necessary then to strengthen and stabilize the financial system and prevent similar crises in the future?
So the first point would be that that banking needs to be understood as an inherently risky pursuit. So you're borrowing short to lend long. You're a maturity intermediator. That's what you are as a bank. There's some banks that generate more fees, but competition has made those fees lower and lower and lower. So you need to lend or do some kind of financial intermediation, and on a non-inverted yield curve, you're going to have to lend long and borrow short. And therefore, you're going to have to continuously replenish deposits, which means to say that if you lose public trust, you're instantly dead. So it's just a kind of sudden death event. So for me, creating rules that massively increase capital, like, for example, Michael, the fact that global systemically important banks have to hold more capital and therefore are less attractive investments than non-GSIBs, Doesn't make sense. Why would you want the largest banks in the world to be less attractive investments?
And what happens there? We've seen the likes of Credit Suisse.
Credit Suisse, one of the 33 GSIBs in the world, had, a lot of people say that they failed because of market conduct issues and they failed because there were massive withdrawals. There were massive withdrawals because of market conduct issues. So you've got to address the cause of the withdrawals. The withdrawals are caused by lack of trust. How do you increase trust? Not by increasing capital ratios, but by running authentic stress tests, by working with other countries, by looking at downstream impacts, looking at exported inflation. But one of the biggest points I would make is, and I would touch on this, is why would countries like China and India and South Africa promote the idea of an alternative currency for BRICS and for the 22 other countries that they want to have them join, including, but not limited to, Iran and Saudi Arabia? And the reason is because they want to evade using the US dollar. And the reason for that was that the US seized $300 billion of Russian assets from central banks around the world.
Which immediately, overnight, eroded trust.
Correct. So if you can just go, because you're the US, and just because it's in dollars, take it away, that's scary for other countries. They don't like that. So whilst one can easily criticize, the way that, these countries like China are governed and their political formation and whether you agree or not with democracy, if you're living in a world where a fiat currency, not a gold-based currency, a fiat currency, that Jay Powell can print as much of it as he likes without anyone intervening. Remember, there's no oversight. There's no one that can stop the Fed doing this. The only thing that can happen is the president can appoint the next federal chair. Other than that, there's nothing that can be done. There are some rules of Congress that can intervene, which are almost never done.
It's a major question of who guards the guardians here.
Yes.
The book actually touches on this, on the role of banks in society, both as agents of the free market and as extensions of the state in the fight against terrorism and crime. Can you just elaborate on how this dual role then impacts the stability and trust that we see in the banking system, given what you've just said about the ability of the US, for example, to intervene at a geopolitical level against Russia? And I think even the SWIFT system, if you look globally at the moment, is being politicized to some extent. I mean, these two ideas seem to almost be at odds with each other.
Yes, it's fascinating. Until 2001, September the 11th, banking was the brain that directed capital to the body economic. After 2001, September the 11th, came out the US Patriot Act, which was voted heavily bilaterally, in Congress and Senate. There were very few people who voted against it, which gave the US government surveillance powers to prevent terrorists. And that began an era of what later became known as market conduct, which includes rules about anti-money laundering, counter-financing of terrorism, and counter-proliferation, which has to do with nuclear armament. Plus tax laws such as FATCA, the Foreign Accounts Tax Compliance Act, and then the automatic exchange of information, and then FICA and POPI. So all of these rules, it became clear to the US authorities that you simply just use the power of the US dollar. So you simply would just say, if you as a bank are doing business with a correspondent bank in another country who doesn't do X, Y, and Z as we prescribe it, then you simply stop doing business with them, or you levy a 30% tax under FATCA. So they used the power of the US dollar to propagate a series of rules and laws that essentially were good laws to make the world safer. The terrorists had to fund the pilots that flew the planes into
the Twin
Towers. Hamas and Hezbollah must be funded by someone. So if you can isolate the people who are funding them, so if you know who they are, what's called the ultimate beneficiary, which is one of the reasons that South Africa got grey-listed, is that we were unable to prove that our financial system can determine the ultimate beneficiary. These are good rules, but they completely change what banking is. So banking is no longer a free market agent. It's an extension of the state. So now if it's an extension of the state, then it's an extension of the state which has got a constitution. That constitution will have certain values in it, such as human dignity or the rights, human suffrage. Don't propagate illegal wars. Don't do mass executions, as has occurred in countries like Saudi Arabia. So what happens is, in implementing market conduct, you kind of had to sign up for liberal democracy.
Yeah.
Now, I'm not quite sure what a country like South Africa is going to do if it does pivot towards a BRICS currency, which has got, and one can see why, because the West has been very greedy over a protracted period of time with IMF loans. One could see the frustration in Africa. Remember, Cyril Ramaphosa was promised by Boris Johnson an $8.5 billion funding of green energy, and a year later no one had come up with any solution for that. And Ramaphosa made some pretty strong statements about that at COP27. So I can see why there is a frustration and why the New Development Bank, which is the Bank of BRICS, wants to create loans in an alternative currency. But who's going to impose market conduct rules, and under which guidance, and under why would there be? So we're opening up a can of worms where we're going to have potentially an unraveling of all the market conduct rules.
Which only really work if you have a unified global financial system and not one that is increasingly looking like it's splintering and becoming more fragmented. You're going to have islands in which different rules apply and operate, and it becomes a quite dystopian future if you want to go down that particular rabbit hole. Just as we reaching the end of our time this week, David, where do you see this heading? Because you emphasize the need to address the erosion of trust in the institutions that are upholding liberal democracy, and there is a broad geopolitical sweep over all of this, in that we do see democracy in decline around the world. According to Freedom House and all of the annual rankings, it's in retreat. How do you propose this trust can be rebuilt, and what role do you see the banking sector playing in this critically important process for those who believe in the inherent values of Western liberal democracy?
So, from a global perspective, I would argue that the behavior of the US Fed has to be addressed in some kind of congressional investigation or the Senate Banking Committee should look very closely at the problem of marking your own homework, doing your own stress tests that are completely unlikely and disingenuous, and the printing of money and the export of inflation, etc. From a BRICS perspective, I think that there's a lot of hype about it, and a lot of people have poo-pooed it and said, don't worry about it, it's not going to happen. Those people, I think, are not aware of the fact that when Nixon pulled out of the gold standard, 6 countries got together immediately and created a common currency, which later became the euro. So the likelihood of there being another currency is, we've got a proven track record of it happening in the 1970s. That took only 3 or 4 years. I mean, it then kind of disappeared, and then it became the euro. So I would say that what clearly has to happen is that from a South African perspective, the South African banking community, which is one of the strongest banking systems on earth, if not in the top 5, definitely. Having consulted around the world, I can tell you that for a fact. This is a very strong, safe banking community.
Because of exchange controls? What underpins and undergirds our inherent financial systemic strength relative to our global peers?
Very good central banking, very conservative central banking. We didn't allow, for example, credit derivatives. We don't just print money. Very, very, very good. We were very fortunate to have very good governance, a very good job done by the Banking Association, very strong leadership. We also came through the banking crisis, and there was a consolidation. We've seen the worst. I mean, we've had banking. Half the banks in South Africa went out of business, and since then we've had more banking crises. We've had VBS, and so it's been contained since the A2 banking crisis, or what's sometimes called the small banking crisis, small banks banking crisis. So I would say experience, good governance, independence, bank independence from government, which is how it's constitutionally defined, and strong leadership and very sophisticated banking systems, and the benefit of international relationships, very high status on the Basel Committee, and conservative.
So therefore, what role should our leaders in the South African financial and broader banking industry and system be playing in trying to recalibrate the global environment for banks to be, A, more resilient to future shocks, but B, regain a lot of this trust that's been eroded specifically in the developing world?
Well, I mean, I definitely think that the banking community should make the points that I'm making, which is that we need market conduct. It makes the world safer. So if we're going to have an alternative currency, if we're even going to have the discussion, we need to talk about the values and obligations and the Kantian values that underpin the concept of market conduct.
Right.
So you've got the Dilma Rousseff, the ex-president of Brazil, who's the CEO of the new development bank, has made statements like there won't be any social or moral requirements. I don't think she used the word moral, but there won't be any, we'll just lend in a multipolar world. So I think that's fine, but then how do we stop terrorism? How do we stop money laundering, drug trafficking? So I think the banks should be making those points at these meetings, ones that I'm not invited to. You know, the CEOs of the banks should be making these points. I think they are walking a very fine line. I mean, they're working in a country. I say, right at the end of the book, I say that South Africa's at the epicenter of this complex debate. That's the last line of the book. Why are we at the epicenter? Because BRIC, the concept of BRIC was actually invented by Jim O'Neill.
Yeah, the Goldman economist.
Yeah.
And at a very different time in the world, was really just an agglomeration of countries with high growth consumer markets that could potentially be the next EM flavor of the month, and how things have changed and evolved.
They took this concept, which was an investment concept, and made it into a political organization. Yeah. And, you know, I think it's...
So how does South Africa find itself then at the epicenter? Is it because we are trying to be perceived to be non-aligned, or present ourselves to be non-aligned? We in almost the atmosphere of Western capital, while being also in the political atmosphere of this new unipolar world, which is very much China-centric. And kind of we still need that Western capital, but politically we're still very much in the atmosphere of China.
Well, we're at the epicenter because of several reasons. One of the reasons is that without us, there's no African representation, so you can't call it the global south. Africa's got 1 billion people, and demographically, Africa's going to have more people in the world of working age than any other continent pretty soon, like by 2050, because of the demographics. I mean, we're the most important continent for the future. That's why we need South Africa. South Africa's got the most sophisticated infrastructure and banking system in Africa. So South Africa is critical, but South Africa also has a constitution. It was democratically elected. So we're one of the countries in BRICS that has got the strongest constitution and the strongest history of overcoming apartheid and a very racist, fascist regime. So I say that we have the most powerful position, although we're punching above our weight.
David, this podcast so far is certainly punching well above its weight, and I really look forward to the third episode where, on that point, we are going to dive a little deeper into how all of this impacts South Africa, what role South Africa has to play if we are to recalibrate and reconfigure the global financial system in a way that is more resilient to these risks and in a way that doesn't increase this splintering that we are currently standing on the precipice of. So, as always, a great pleasure having you on the show. Take care.
Thank you, Michael.
That was David Buckham, author of Why Banks Fail, one of the hottest books to be released this year ahead of the December period. A great read, Unrelenting Bank Runs, The Conundrum of Central Banking and South Africa's Place in the Global Order. Thanks so much for tuning into our second episode of the Monocle Banking Podcast. As I said, we're going to be delving deeper into South Africa's location in this broader global conversation about the reconfiguration of the banking system. Remember, if you've got any questions or topics you'd like us to cover, feel free to reach out to Monocle. You can also find us on all good podcast platforms, Spotify, Apple, Iono, all of those. And for me, Michael Avery, it's been a great pleasure bringing you the latest banking podcast by Monocle. Take care.